Hey, thank you so much for joining us for Financial Foundations. This is the insurance lesson, and my name is Elian Levatino. I am a certified financial planner and a advisor here at Benchmark Wealth Management. And with me, I have Hall Ballinger, and Hall's going to join us. He's also a financial advisor at Benchmark, and he'll be joining us to teach the insurance lesson. And when I say teach, I mean we're here to teach. We want to help you understand the different coverages, some of the specifics of insurance. And more importantly, once you're through all of this, I hope some of the takeaways that you take from this will be, hey, I need to change my coverages, or I need to at least look at my coverages, or maybe you just need somebody to look over your shoulder for a second opinion, and we're happy to help with that. You may even take some inventory of the insurance you have and consider, do you need to keep it? Is there some you might need to get rid of? Do you need to move things around? All that kind of stuff. We're available to help you with all that whenever that time comes. So I hope you get a lot out of this lesson. Again, we're here to teach and just to help you understand the different types of insurance. So Hall is going to jump right in. Let's start with auto insurance. Hall, take it away.
Yeah, absolutely. And just to kind of mention, I know a lot of people will hear insurance and immediately the eyes glaze over. This is one of the more interesting lessons we teach all year. A lot of the other ones are more fun in terms of the actions you're taking, but this one just has a lot of great content in it. And again, we're teaching from the aspect of we want to educate you to make the informed decision for yourself. We're not going to make any specific recommendations to you personally because everyone's situation is different. But just wanted to let you know that that's where we're coming from. But again, if you got any questions, we're happy to help any way we can. Regarding auto insurance, there's a few different ways to initially go about it. Obviously, you've seen the big name brands out there as well as there's some local brands, and there's big brands that have local branches and everything like that. And if you've been in any type of auto accident before and you have a 1-800 number to call, I'm sure you have your own story about the level of service that you received there. We do understand the value that a local agent can add, just similar to the value that a local advisor could add. It's a much different level of service that you'd be getting, and just making sure that you have someone that knows who you are. You don't want to be a cog in the system, but you want someone who's genuinely going to be looking out for your best interests and just making sure that you're being well taken care of because they care about you, not the numbers that you're representing. So a few different things go into auto insurance. There's comprehensive collision, bodily injury, and property damage. There's a few others as well, but comprehensive just means that's the part of the coverage that's going to cover anything that's not a car collision. So if a tree falls on your car, or there's vandalism or theft, anything like that, that's what the comprehensive coverage is there to take care of and make sure that you're being covered in the event of one of those actions taking place. Collision, obviously, as you can tell, is when there is a collision between two vehicles. There's a deductible that applies to any car-on-car crash, and then also some stationary, if you run into a light pole or anything like that, also is considered collision. Bodily injury so it'll look like BI/PD, but bodily injury / property damage. State minimum for Tennessee, they list it as 25, 50, 15. So that's $25,000 in coverage for bodily injuries per person. So if you're in an accident, it'll cover up to $25,000 of medical expenses per person. The 50, so that's the 25, the 50 is $50,000 of coverage of bodily injuries per accident. So if you had 7 people in the car, it's going to limit and cover up to $50,000 of medical expenses and coverage for those people collectively. And then the 15, that is the property damage. So if there's any type of damage that exceeds that $15,000 mark, then you are responsible for that as well. And again, these are state minimums. These are not our suggestions on the amount of coverages to have. Definitely speak to an agent to see what your liability is and what makes the best sense for you. A few other additional coverages that are optional is medical pay. So it's a small coverage for passengers just for the smaller medical bills, nothing that's of the thousands and thousands of dollars a type, but maybe there's maybe you had to get a small procedure done. And so that's something that'll take care of that. There's also the uninsured motorist / property damage. And so this is a coverage that will insure you from other people that might hit you in a wreck and they're not insured. So if normally the person liable for the accident is the one whose insurance is on the hook, but at 52% of the population of Shelby County is uninsured. So should that happen, you are on the hook for that. Your insurance is on the hook for that coverage, simply because that's by law, we're all required to be insured, but that's just not the case here in Shelby County. And then loss of use. This is simply if something happens to your car and you have to take it to the shop for a week or 2 weeks, that the insurance company will provide you or supplement you the funds to have a vehicle to replace that in the meantime. And then T&L, towing and labor, will cover a tow, roadside assistance, bringing you gas, anything like that should your car break down along the route, especially a road trip, anything like that. And then the last one is forgiveness. So this is a provision. You might pay a little bit extra up front, but should something happen in a moving violation or anything like that, it won't jack up your rates. So I'm sure you've seen commercials about it saying that there's free forgiveness for your first moving violation, anything like that. So this is paying a little bit extra for that forgiveness so your rates don't jump up should something minimal like that happen. So what affects these rates? What tells the insurance company how much they should be charging you for these rates? Well, there's a few different things that go into it. There's age, sex, driving history is a big one, moving vehicle violations, your moving vehicle report. So that's like speeding tickets, things like that, accidents, and then your credit report. So that is a big part of the equation. And again, we are also here to help make sure that you're doing the best you can financially to make sure that is going to be in the best situation for you moving forward. But those all go into a big equation, and then they spit out and they'll tell the insurance companies what to charge you. And so work with your agent. They really know how that equation works and how to make sure that it's working in the best way for you. Elian, this is a lot about auto. Tell us a little bit more about home insurance. What does that look like?
Thanks for that tutorial. That was fantastic. I feel like we might have jumped the gun a little bit. So let me zoom out a second. Let's define insurance first. And defining insurance is a transfer of risk. You are transferring the risk of things that could happen, things that are unforeseen, to someone else. So in the scenario, what we're doing is we're transferring risk of auto accident, or hurting someone else in an accident, or damaging your own car in an accident, or somebody getting hurt inside of your own car. Insurance is supposed to transfer that risk to an insurance company to cover you in case an event like that were to happen. And exactly what Hall talks about, bodily injury, property damage, these things are just unforeseen. We can save up for some emergencies. And if you know us, we're big fans of Dave Ramsey and the baby steps. And we encourage people to be saving money for emergencies, hefty emergency funds of 3 to 6 months of expenses. But as some of you know, medical payments can get a little out of control. And so transferring the risk to an insurance company is exactly what we're talking about here. So transferring risk of damage to your car or damage that you do to someone else in an accident is what auto insurance is all about. So let's jump into homeowners insurance. And homeowners insurance is the transfer of risk should something happen to your home. And even if you were to damage, or if someone were to come onto your property and get hurt, or if you were to damage someone else on your property or even somewhere else, and I'll get to that in a second. Homeowners insurance can be split up into 2 categories. You have what's called replacement cost and actual cash value. Now, replacement cost is, let's say you have a home and the home burns to the ground completely. Just because you paid $250,000 for your home doesn't mean that's what it costs to replace it. Those are 2 different things. That's the market value versus the replacement cost. The market value is what you paid for it. That's what you were willing to pay. That's what someone was willing to sell it to you for. Replacement cost is different. Replacement cost is, what if the insurance company had to start calling all these contractors and start buying all the wood, buying the nails, buying the mortar, the brick, everything that has to do with putting a house up. If they had to make those phone calls and get that entire construction contract started, what would it cost to replace that house? So don't assume that what you paid for your home is what you should be insured for. Your agent should be talking to you about what it takes to replace the house. So you're looking for replacement cost. Actual cash value is a depreciated amount. So I'm not going to go into actual cash value for your home, but I'll go into actual cash value for your personal property. My wife and I recently just bought some couches, and they were incredibly expensive, a whole lot more than what I thought was going to happen. Now, the couches that we've had for 20 years, I paid a pretty good amount for, but there's no way they're worth that today. They've been depreciated. There's wear and tear. There's a spaghetti stain on one side of it. I'm sure you can relate to that. We just had to flip that cushion over. Considering that not everything holds its value 100%. Matter of fact, very few things do. Now, very few things appreciate in value. Most of your personal property is going to depreciate in value. And if something were to happen to that old couch, I'd be really surprised if the insurance company wrote me a check for more than $25 for it. It just doesn't have the value that it had when we bought it. The new couches will, because they're brand new. So when we talk about replacement costs, if you don't have replacement costs on your personal property, that could be a problem. Because if your house were to go up in flames and you were to lose all your personal property as well, if the insurance company just wrote you a check for the depreciated value of all your personal property, that wouldn't be nearly enough to replace it all. Because you're talking about trying to replace old stuff with new, and that can get kind of expensive. What you're looking for in your personal property is that there's enough coverage to replace everything in the house, not just write you a check for the depreciated value. So please double check your policy and make sure that you have replacement costs not only on your home, but on your personal property as well. In addition to that, you have liability coverages that come with your homeowner's policy, just like you have for auto insurance. Hall mentioned liability, property, bodily injury, and property damage for if you're in an accident and you cause damage to someone else, the bodily injury and property damage would cover that other person. Same thing for the liability on your home. So if you carry liability coverage on your home, this is just called homeowners liability coverage. This is not called bodily injury or property damage. It's just liability. Now, what that means is if someone comes on your property and gets hurt, you have liability coverage to cover that. Even more importantly, your homeowner's liability extends to everywhere in the world, not just on your property. So if you're off of your property and you inadvertently or negligently damage someone else off of your property, your homeowner's insurance will respond to that, as long as you're not doing something illegal. There are all kinds of give and takes in these contracts, so make sure you're reading them carefully. Not that you should ever be doing anything illegal, but you understand what I'm saying. The point is that the homeowner's liability is going to extend far beyond just the bounds of your own property. So it's important that you have enough coverages there. What is enough coverage? We should probably have a conversation. Hall mentioned minimum coverages for Tennessee. There are minimum coverages for Mississippi. And for those of you that are joining us that are brand new, never heard of us, we're with Benchmark Wealth Management in Memphis, Tennessee. So you're going to hear us talk a lot about Tennessee and Mississippi and Arkansas because we're right in the corner of those three states. When it comes to the specifics of your situation, everybody's different. Some people need more liability than others. For those with high net worth, you need to be considering umbrella coverages, which is liability that goes over and above the liability on your auto and your home. So these are a bunch of things to consider. Everybody's situation is different. Let's talk about yours if you think yours is a little complicated, or you at least want a second opinion of somebody to look over your shoulder. In addition to coverages for the home and the liability and the personal property, consider loss of use. Should you ever have a covered claim where you had to actually leave your home because you couldn't stay in the home while they were doing the repairs, there's coverage for loss of use, meaning if you had to stay at a hotel or if you were renting an Airbnb or something like that, there's coverages for that kind of thing inside of a homeowner's policy. Should you have that coverage? None of this is a default. Please look at your coverages very carefully and make sure if you want to have loss of use, that loss of use is inside of your policy. In addition, consider scheduling some personal property. Now, when I say schedule, I'm probably not going to list out my couch and my recliner and my TV, because I'll just include all that under personal property. But I will absolutely list out my wife's engagement ring. That was a big chunk of change. And any jewelry that you have, any collectibles, any fur coats, any gun collections, any coin collections, something that excuse me, something that has value outside of what would just be considered regular old personal property needs to be specifically scheduled. And what happens is you would tell the company, look, I have this ring. Here is the appraisal for the ring. This is the value of the ring. I want to specifically schedule it so that if something were to happen to this piece of jewelry or this gun collection, or I have a buddy who's got a Boston Celtic collection of everything from 1986. He's got all this memorabilia and it has values attached to it and appraisals attached to it. He's listed all of them out on his homeowner's policy, and the company knows that if something were to happen to this memorabilia, it's very specific on how to replace it. So I would absolutely consider that, because some of these things are transferable, meaning you're taking them off property. Your jewelry is being taken off property because you're wearing it. And the odds of losing it or smacking your hand against the wall and losing the diamond in the ring, those are very real possibilities. And those risks increase as you take them off site. So consider specifically scheduling the things that are higher value. That way there's no question what the value of that was, because it's been appraised and you're paying a separate premium for that. They will charge you extra, but it's pretty minimal. That is not an expensive coverage, and I would encourage everybody to have it. Without that, jewelry, some policies say jewelry will only be covered for up to $1,000 and for theft only. So if you were just to lose it, no coverage. If it's stolen, you would have coverage, but only up to $1,000. If you schedule that personal property, you have coverage. Theft, they call it mysterious disappearance. If you just lose it, there's coverage for that. So please consider doing that for some of your very specific higher value items. What is not generally included in homeowners policies is earthquake coverage and flood. And those of you that ever had any flood damage, you know how difficult that is. We haven't experienced too many earthquakes here in Memphis, but having that coverage is not a default. That's something you have to actually get separate. Not all companies will offer earthquake coverage. Some will, but others will not. And if they won't, you have to go get a separate coverage elsewhere, and that can be pretty expensive too. So be sure to check with your carrier to see if you actually have earthquake coverages, and flood coverages can only be given through the National Flood Insurance Program. No primary insurance company can offer that to you. So you actually have to go through the National Flood Insurance Program, which is a governmental organization, in order to get flood insurance. Consider additional things that you can add on. We've talked about loss of use. We talked about scheduling jewelry. Consider adding what would be considered ID theft. You can actually get a certain amount of identity theft coverage included in your policy. Most of them will not be proactive in identity theft, but they will be reactive. And what I mean by that is, if you were to have a personal an identity theft event, they will help you restore your credit. They will make all the phone calls they need to make. They will help you replace all your cards. They will help you fraud alerts and all that kind of stuff. But keep in mind that most of these policies are a little bit more reactionary. And if you wanted more proactive monitoring, you probably would need to get that coverage elsewhere. But consider identity theft as an addition to your homeowner's policy. And lastly, consider water backup. Now, water backup is different than flood. Flood is water that enters your house from the outside, from the ground up. There's a way more specific definition of that came out of Hurricane Katrina, and I'll let you go read all the law around that. But what water backup is a backup of sewer and drain. That's not necessarily flood. You have to prove some kind of obstruction in the sewer or an obstruction in your pipe for it to be called water backup. And the obstruction can't just simply be water. It would be something that's caught in the sewer, or a clog in your drain where something's come back up through the sink, or God forbid the toilet. Having that kind of damage that comes back through your home through a drain, that's not normally covered, and you would need to add that as what's called water backup to your homeowner's policy. A coverage I skipped over is there's actually coverage for other structures on your property, and that includes swimming pool, that includes a fence, that includes an outback, a shed in the backyard, all those kinds of things. So that was like drinking through a fire hose of homeowners insurance, but there's a ton of stuff that you can get inside of auto, inside of homeowner, and then umbrellas that go over auto and homeowner. This is incredibly complicated stuff, and missing out on there's nothing worse than calling your agent and saying, hey, I got a claim, and your agent going, I'm sorry, you don't have coverage for that. That is just a sinking feeling. Please let us look over your shoulder. If you have any questions about this, we're happy to help.
And to piggyback off of the flood insurance, a lot of people don't know this, but flood insurance, if you are in a flood zone, is required, and flood insurance is not inexpensive. And so if you are looking to move or talking to your realtor, make sure one of the questions you ask is this home in a flood zone? And depending on that answer, will probably determine if you have to get some of that flood insurance as well. Just something to keep in mind.
And even worse than that is if you're not in a floodplain and you think, oh, I'm good, I don't need any flood insurance. That's not always true. It could be that you're within 500 feet of a floodplain, or within 1,000 feet. I'm within 2,000 feet of a Wolf River floodplain. I went ahead and got flood insurance because you just never know. If you're anywhere near one, or even talking to some of the neighbors before you even move in, hey, have y'all ever had water come anywhere near the street? Having those conversations, and floodplains can be split up into 100-year floodplains, 10-year floodplains, 1,000-year floodplains. It's all over the place. So Hall's right to have that conversation with your realtor, or at least the people in the neighborhood, and just ask around, have they ever had any water damage? That is, again, a ton of information, but we're not done. We got plenty more to bring to you. Hall, let's jump into life insurance. Can you explain life insurance? Do I need it? What is term? What is whole? All that kind of stuff for us.
Yeah, absolutely. And so up until this point, the coverage we've talked about, home and auto, that's coverage for you. That's coverage for your belongings, your possessions. Life insurance is coverage for everyone that depends on you. So should something happen to you, I want this amount of money to go to these beneficiaries. So it's just making sure the reason it's there, the reason people get it, is to make sure that any of their loved ones are going to be obviously devastated emotionally, but compensated financially for the loss of your income should something happen to you. So the idea behind life insurance, and what we share here as well, is the ultimate goal, ideal goal, is to be self-insured, is to get to the point where your assets, your net worth, what you've worked for, is going to be able to work for you and provide for your family moving forward, to where life insurance is no longer needed. If something happened to you, you're financially independent. Your remaining kin will be financially independent and don't necessarily need that life insurance, but everyone's situation is different. So, and not all of us are at that point. I certainly know I'm not, but as we work towards that point, there's a few different options we have to make sure we do have that coverage until that time comes. So a few different options. One is, I'm sure you've heard Dave mention it at all if you listen to him, but term life insurance. Term life insurance is coverage for a specific set of years, for a specific dollar amount, for a set premium every single year, or monthly or quarterly, however you decide to pay. So it's taking into account from 20 years from now. Normally there's a 20-year term. You can choose a $1 million, $500,000, $200,000 death benefit, and then you're just simply paying the premiums. Once that time period ends, you're no longer covered by it. You do have the option to re-up the contract for another year, but that is not the premiums will certainly jump, and they jump significantly. So when you do set out to buy, if you are looking to buy term insurance, make sure you're buying for an appropriate time period, and make sure that you are constantly taking into account what it is you're covering. If something happens to you, you're covering loss of income, but also maybe you want to make sure that your current home is going to be paid for as well. And the finances that are coming in, the death benefit that comes in, is going to be able to generate money for your family to live off of as well. So just make sure you're taking everything into account when you do apply. You do need to go through a physical just to make sure that you're healthy, in good health, and that will determine your rates. Just height, weight, health, all that kind of thing will just go into the factor of the rates that you'll be paying for that insurance. Another type of insurance is whole life. So kind of what it sounds like, it will cover you for your entire life. There are some contracts that will go to age 100, so make sure if this is something you do seek out, determine which one that is. But with whole life, whereas term, it's a purchase contract. So you're saying, I'm going to pay you $200 a year for X amount of coverage, and you pay $200 a year every single year until 20 years is up or whatever that time period may be. With whole life, you are guaranteed a fixed rate. So you might pay $200 a year every year, but that rate is guaranteed never to go up. The difference being with whole life, one, you're paying a different premium for the same type of coverage. So that 200 in whole life might not purchase as much coverage that a term would. But that 200 you're paying for fees and for that coverage, but also there's a cash value portion added to the contract value. So of that 200 that you put in, it might, and again, these are made up proportions. So every contract's different, but $50 of that 200 might go into the cash value portion. So every month or every year that you're paying it, it's going to be slowly building up the cash value. So now 20 years down the road, you have a cash value portion of your whole life, but you also still have that death benefit. Should something happen to you, the insurance company will take that cash value, but pay out the death benefit. But should you, some people might decide to use that cash value for other reasons, and you are allowed to borrow against it. You are allowed to surrender the contract for the cash value. And it's some people view it as a way of savings. That's not necessarily what we might suggest, but again, every situation is different. So we'd certainly be happy to talk to you about that. So those are the first two insurance products that were kind of introduced into the market. But then people started wondering, you know what, I feel like there's another possibility here. And so they introduced what's called universal life insurance, or variable. And Elian, do you want to kind of touch on what that does?
Yeah, the reason it was introduced is because everybody understood that whole life was lacking. And I hope you picked up on a couple of things Hall said. One is that whole life is significantly more expensive than term. And as you can imagine, if you're an insurance company and you want to cover somebody for 20 years, that's pretty reasonable. But if you want to cover them up to age 100, more than likely, you're going to have to pay out that face amount benefit, because somebody's probably going to die before age 100. And if they're willing to pay that premium all the way up through age 100, you're probably going to have to pay that claim. The odds of having to pay a claim for a healthy 25-year-old who got a 20-year term is pretty low. So the insurance company looks at that and says, okay, we like our chances of never having to pay out $500,000 for this 25-year-old to pass away. But whole life probably will get paid out. So what insurance agents were taught to do is to let everybody know, you might be paying a little bit more for whole life, but let me show you how you have some cash value built up. And they started calling these investments. And I want to look dead in this camera and be absolutely clear. An insurance policy should not be a part of your investment portfolio. I hope that was clear. Especially a whole life or a universal life policy. These should not be considered investments. They are investments, but they're terrible investments. And we're not usually going to suggest that you use them as an investment. Let's use them for what they are. Let's use them for life insurance. We'll use them for whatever time period we need to use them for. Now, I hope you also caught what Hall said. Inside of a whole life policy, if you were to pass away, your beneficiaries get that face amount. But that cash value that's been built up, that money that was supposed to be yours, they keep it. They keep it. That investment that you were making, they keep it. It's theirs. So people started catching on to this, and they're like, this is a little ridiculous. We don't like this. So they rolled out something called a universal life policy. And yes, if you pay a little bit more premium, they will guarantee that when you pass away, not only will you get the face amount, but you'll also get the cash value. Now, part of the way they make that guarantee is they start taking that cash that's in the policy and they invest it on your behalf for you. into some fairly conservative things so that it will continue to grow. And that way they can guarantee on their end that they can pay out that cash value plus the death benefit. Now, just because that's the better of whole life versus having no insurance, that doesn't mean the universal life is right for you. It could be that you can have a term policy or some kind of combination, but please don't look at life insurance as an investment. It is not an investment. We're gonna guide you in a different direction, and I have no qualms about being that blunt about what whole life and universal life is. In addition, of course, there's money makers to be added to these insurance policies. And what I mean by that is, and I'm not coming down on insurance companies because these are valid coverages, but these are things that they can add on that can be a pretty easy premium for them to collect on, and make you decide that you want to pay them more premium, not only for the base insurance coverage, but some of these additional things that they call endorsements. You can endorse your life insurance policy to add what's called return of premium. And what that means is if you're willing to pay them a little more over the entire life of the policy, and it turns out you never use that policy, they will turn around and send you all your premium back. Sounds like a good deal, but you're also kind of looking at that as an investment. When they say that they're going to return their premium to you, if you pay them a little more, it's not just a little more, it's a lot more. So when they return that premium, if you were to say, you know what, if I would have taken that extra that I was paying them and I were to have invested it instead of investing it into the life insurance policy, I think you'll find that you would have been a whole lot better investing that money elsewhere. So again, we're going to, whenever we sit down with you or we talk with you about your coverages, we're going to be very, very specific on alternatives and only buying the pieces that you need, rather than throwing a bunch of money at something that may not be the best thing for you. In addition, there's something called a waiver of premium, which I'm actually a big fan of. I find this very interesting. When you include waiver of premium onto your term policy, I don't know if you can have waiver of premium on your whole life. That'd be something to look into. The waiver of premium is the insurance company will pay the premium on your behalf should you become disabled. And we're going to talk about disability insurance later on, but it should be nice that during a time where you're disabled, if you're drawing disability income, that you don't have to pay your disability income toward life insurance anymore. So I do find waiver of premium very, very interesting. Another thing I find interesting to add on to life insurance policies is a child rider. And boy, this is always hard for me to talk about, but if you wanted to have a little bit of coverage for your children to pay for what could possibly be the worst thing a parent could think of, a loss of a child, if you felt like you needed a little bit of coverage for burial expenses or something like that, most life insurance companies will add a $10,000 or $20,000 rider onto life insurance to be able to cover that kind of an expense. So inside of life insurance, there's a lot of stuff going on. There's a lot of people in your ear. You get friends, you get family, you get insurance agents, you get financial advisors in your ear talking about life insurance. Please make sure that you're buying the right type of life insurance, that you're insured for the right amounts, and continue to look at your life insurance over the years. Look, needs change. You're buying life insurance in your 20s. You might have a different need in your 30s. You may have more of a need because you've gotten married. There's children, there's additional expenses, there was a bigger house. In your 50s, you might need less because you've accumulated more money. The kids are off the payroll. You might even have paid for your house by then. Your needs are going to change over time. So this isn't a set it and forget it type of thing. Life insurance is a living, breathing thing that's your needs are going to evolve over the years. So please make sure that you're keeping up with it. Now, back to what I was saying before, we're talking about waiver of premium and disability. Hall, should each of us have a disability policy? Is it a requirement for all of us?
Yeah, great question. So disability, there's a few different types out there, and the purpose behind it is, should something happen to you that disables you from doing your current occupation or any type of work, that you're going to be compensated and that you're just simply not out of work. It's ensuring that you're still going to have an income should some type of misfortune come to you, and you are still, there's no life insurance to be paid. So that coverage is still Depending on the type of insurance you have, it's still going to be in place, but it won't be paid out to your family. So disability is just making sure that should something happen to keep you from doing your job, earning an income, that it's still going to cover you and provide that income for you. There's two different main types. There's short-term disability and there's long-term disability. Short-term disability is 90 days or less. You're working in a warehouse and something falls and breaks your leg. You need to recover, have 90 days. And so the idea behind that is that's a short recovery period, and you just need that income to make sure that you're going to be okay between now and when that leg heals and you get back to work, or arm, or whatever it may be. So that short-term policy is going to pay out for up to 90 days of what your income was. Depending on your coverage, normally they'll pay up to 75% of your income. But again, different coverages vary in different ways. So short term, that's just making sure, again, up to 3 months. The idea behind it is, and this is largely for people that are, should something happen to their income, they cannot supplement it for the next 90 days. They have to have income there. We are big believers in an emergency fund, and we always like to encourage people to have 3 to 6 months of their current living expenses. So whether you spend $2,000 a month or $10,000 a month, have 3 to 6 months of those expenses saved up in an emergency fund. So should something happen like this, you're self-insuring yourself from this short-term period of not being able to work and earn an income for, again, 3 to 6 months. Long-term disability is going to be longer than 90 days, exactly what it sounds like. So should you lose your voice and you happen to be a singer or a financial advisor, that you need to have that insured. And so making sure that if I lose my voice permanently, I can no longer do this job, and I can no longer earn the income that I was making. And so having long-term disability to provide, again, it's not going to be the entire income that was guaranteed that you were making, and it's going to be based on whatever income you were making at the time of insurance. But it's going to provide up to, whether it might be 75% or 50%, whatever that policy dictates, and saying, okay, we understand you can't do your job anymore, your primary career, so we're going to make sure that that's supplemented. And so they'll supplement you. Some policies will simply supplement you for, and Elian, jump in here if you have more to add, but they'll supplement until you have gotten to the point where you can go find another job that maybe I can go do manual labor and make sure I can go do landscaping. And so they don't want me earning 75% of my old income versus in addition to a full landscaping salary. So there are adjustments in there for that, just something to be aware of. But long-term disability, we do see that as a big necessity. We are big believers in it. And just making sure, again, that what you've worked so hard for in your life and your career, a lot of people spend hundreds of thousands of hours preparing and learning and growing in their career. And should something hinder that to where you can no longer make the income that you were making, and that would be a detriment to your family, we want to make sure that that's covered for, and that's going to stay secure regardless of anything that happens.
Yeah, to piggyback that, Hall hit the nail on the head. You have things that you're trained for, and to use Hall's examples, we're financial advisors, and I lost my voice last year. That was an interesting 5 days, and I was told to be quiet. And you should have seen me in here trying to have meetings and typing stuff on a Word document so people could understand what I'm saying. That was pretty difficult. Should we lose our voice, that doesn't preclude me from writing, from educating, from doing all the things that it's still up here. The mental capability is there, but I can't do the job like I was doing before. So an insurance company can tell you, if you don't have the right coverages, they can tell you, look, you may have lost your voice, but you can do something. We can train you for something else. And they absolutely will. And whatever money you make at that new job, whatever the difference is from what you were making to that new job, they will only pay you the difference. So this is their way of saying, hey, we don't want to pay out this entire amount. And we don't have to because of the way the contract is written. So what you're looking for is inside of the policy, you're looking for something called own occupation, meaning if I cannot do my own occupation, then the insurance company is paying out 100% of the benefit. If I can do anything, then I have to go do something. That's called any occupation. So if the contract is written as any occupation, if I can do anything, they'll pay me the difference of what I'm not earning versus what I was earning versus what I'm earning now. They will pay me the difference, but they will force me to go back to work. And the same thing, I actually had a doctor friend, it's just over a decade ago, who lost a thumb and in an unfortunate accident, and he couldn't tie the sutures anymore. And because he had own occupation, he's on full disability because he lost his thumb. And unfortunately, we lost a good doctor there too. But you want to make sure that whatever coverage you have are the coverages that you think you have. There's nothing worse than if I were to lose my voice and I called my disability. I can't call them because I wouldn't have a voice. But if I went to them and I said, "Hey, I'm fully disabled now," and they're like, "Yeah, maybe, but you can go do something else." That's the sinking feeling that you get when you don't have the right coverages. So please make sure you're reading your disability coverages very, very closely. I'll go ahead and jump into the next topic of long-term care. Now, long-term care is care in your later years where you're just not able to care for yourself. Now, long-term care will kick in once you can't do specific things, and there's called activities of daily living. And there's 6 or 7 of them, I can't remember, but once you can't do 2 of them, which are like feeding yourself, bathing yourself, clothing yourself, transferring from a bed to wheelchair, or walking around, just being able to care for yourself. Once you're not able to do 2 of those, you're eligible for your long-term care insurance to kick in. Now, what that will do is it will cover skilled nursing, as long as it's written correctly. It will cover skilled nursing in home care, because the insurance company would much rather pay for skilled nursing in the home rather than you having to go to a facility, because facilities can get pretty expensive. They would love for you to stay in your home, and I'm sure you would too. So they will send people to your home. They will, and if it's needed where you need a 24-hour care and had to go into a facility, the coverage would kick in 100% to cover a stay in a facility. Now, I will stop here, and I'm going to send this back to Hall, because I want Hall to talk about some specifics of, what does long-term care insurance cost? What is the average stay? What kind of coverages should I be looking for?
Yeah, absolutely. So just in terms of what that stay looks like. So let's say you do have this long-term care policy and you want to know, okay, what is that going to cover me for, and what do I need to be covered for? The average cost of a long-term care, if you were to move into this facility and have that full care and coverage, the average cost for a middle of the road, not the Ritz-Carlton, but not something that's going to be unlivable, is going to be between $4,000 to $6,000 a month. So we're looking at about $60,000 a year. So it's a considerable chunk of change. But you also have to realize that they're taking care of every single need you have. You're no longer paying for gas. You're not driving. You are just making sure that you are living day to day. The average stay, and this is where it gets a little morbid, but the average stay in a long-term care facility is 2 years. Now, this does include outliers of people that maybe stayed for a week, and people who simply might have been fighting with dementia and stayed for 7 to 10 years. So, I mean, it can go both ways, but the average stay, again, is 2 years. So you want to make sure that you're going to be covered with that long-term care policy. It's going to cover you for the entire time you're in that care facility. But if you're looking at, should I get long-term care? That's when you're breaking it down and you're seeing, okay, can I self-insure myself against this risk? Should something happen, would I be able to pay out of pocket $60,000, $80,000 a year for a long-term care facility for potentially 10, 15 years? If the answer is no, then a long-term care policy will probably make sense. If the answer is yes, well then again, you are at that self-insured position, and we're big believers in using what you might be paying for that premium, similar to what you'd be paying for for insurance policy where you can invest in. Instead, don't pay that premium and use the difference, use what you would use for that coverage to simply invest. And we are fairly confident you will find that you'll like the results through strictly investing and making sure that that money is working for you as hard as it can be in a direct investment and versus a roundabout investment, whether it's through life insurance policy or just having excessive coverage for other different types of things. So again, everything that goes into this, into that factors are, so your home, you know, if you move to a long-term care facility, you're not going to be living in your home anymore. So add your home value to your net assets, add it to your total, what could be providing income for those years, and just make sure you're taking everything into account. Again, this is a lot of stuff that we're going over. There's a lot of factors to take in for it. And so that's, again, why people like us are here. We're happy to help walk through these things, make sure that you're not missing anything, and make sure that you're properly covered. We'll never recommend you get more insurance than you need. Obviously, some people might find peace in that and comfort. And if that's you, that's okay. But it's our job to educate you, to let you know what you absolutely need and what's going to be imperative to make sure that your life, your family is going to be taken care of, versus what might be more of a comfort decision. And so if you want to make that decision, by all means, but we want to make sure we're doing the best we can to educate you to make that fully informed decision. We've covered a whole lot. This was, like Elian said, drinking from a fire hose. We understand that this is not easy material. This is material that is not fun to talk about. It's very, it can get morbid. It can, my wife personally will not talk to me about life insurance more than 5 minutes. So I know I have a very specific time frame to get my point across and make sure that it's where it needs to be. But if you want to talk to us about it, our time frame is much longer. We're here to help any way we can. And we just want to make sure you're getting the right care you need. And if something like, we don't do home or auto insurance here, but if that's something you need help with, we know people that do. And we're big believers in making sure that you're not getting coverage that's being sold to you by a big corporation, but by someone who can shop all the corporations out there, all the life insurances out there, all the long-term cares out there, and make sure you're getting the best rate that you can possibly get. So if that's something you need help with, please feel free to reach out. You can call, email, find us through Facebook, follow us on LinkedIn. We're happy to help any way we can. And if you have other questions as well, there'll be more teachings, more lessons coming out soon too. So stay tuned. We appreciate your time, and thanks for staying tuned.
Thanks, everybody. Take care.